Okay, video 2 here. We're going to continue on with investing. Inflation is basically the general level of prices going up, rise in prices. Okay, inflation risk is basically where your money might not be worth as much from year to year. The danger that money won't be worth as much in the future as it is today. Okay, we can't control the future. Like 2 months ago, markets were very, very good, best they've been in years. And then this COVID pandemic came through, and it's really wiped the markets out. Um, Not a good deal. So we couldn't have predicted that. 3 years ago, a couple months ago, we probably could have and did more. But this thing has shut down our economy. So this inflation or deflation can definitely hurt. So going on, some types of investments that we are going to talk about: stock, bond, real estate, speculative mutual funds, and index funds. Bonds, very safe, very low risk form of lending to a company or government. So it's basically a bond is when you lend somebody money, all right? Pays interest to the lender until the maturity date is reached. It's least amount typically. Risk-wise, very, very low. It pays interest and it's fixed, so it's a guaranteed amount. So if it's 12%, it's going to stay at 12%. You've seen buying, during World War II, you could buy war bonds. Basically, the country needed to come up with money. You buy the bond, and then when it matures, when it's due, you can cash it in. You get the amount you paid for it plus interest, bonds. Stock, ownership in a company. So if you own stock in a company, you're an owner, you're a shareholder, and you own stock. The more stock you got, the bigger piece of the pie you have. Stock returns. So if you make money on stock, those are considered dividends. Dividends, share of profits distributed in cash to stockholders. Okay, so company declares dividends, they'll push out money they'll push out profits in the form of cash. But dividends is when you make money on your stock, basically. Stock returns, capital gains. Market price is the current price a buyer is willing to pay for stock. Stock sells for a price higher than what was paid. That's a capital gain. So if you sell it for more than what you paid for, you got a capital gain. If you sell it for lower, you lose money, and you just lose money. So if you make money in your stock selling, capital gains. If you don't, you just lose money. Real estate is land, apartments, housing, okay, buildings, commercial buildings, things like that. Rent, owning apartment buildings. Those are all types of real estate. Real estate's really good most of the time. It's expensive, but if you can get into it, good returns off of it. Speculative, these are high risk futures. Those would be like buying, grain, oranges, coffee. Stock options would be there, the next one. And then collectibles might be paintings, jewelry, antique cars, baseball cards, and memorabilia, things like that. Those markets tend to go up and down. High and low, fluctuate. Very high risk here. Mutual fund. We'll talk quite a bit about this. So you go to investment place. They're going to invest you in many different levels of risk, and that's what a mutual fund is. It's a portfolio of different investments. So you might have some bonds in there, some stocks, real estate, and speculative. Okay. So let's say you have a bad year at the stock market and that fails. Well, if you had all of your money in the stock market and that fails, you would lose all your money. But in a mutual fund here, if you put some in bonds, stocks, real estate, and speculative, all different risk levels, let's say stock fails, you have these other three investments, bonds, real estate, speculative, to carry you through. So it's don't put all your eggs in one basket. A little bit smarter form of investing in mutual fund. When you invest in many different areas, different risk levels, and they can all play off of each other. So if one fails, the other few can keep you going. So it reduces risk in your investment, saves